Welcome to my bubble where we do a little bit of adulting, a little bit of healing, and a little bit of creating. We are back again. Hold on. Oof, I have not had a wig on in so long, bro. And it's just a whole bunch of things going on. Anyway, we're back talking financial literacy, and we're back talking how to get your money up, basically. So, today we are talking stock options. What is that? If you don't know, let me tell you. Is that door open? It's actually not. Shout out to me, because I would have been so upset if I had to get up and close that. Anyway, stock option. Basically, it's exactly what it sounds like. It is giving you the option / having the right / option to buy or sell, whatever you're doing, a certain stock at an agreed upon price, aka the strike price, on a certain date. So one more time, what is a stock option? It is your option to buy or sell, whichever you negotiated, a certain stock at a certain price, aka strike price, on a certain date. Now, there are two types of options. There are two types of options. There are calls and there are puts. A put is something you would get if you expect the price of a stock to go down. So if you're buying a put, you're negotiating to sell your shares of that stock at a higher price. Okay? And if you buy a call option, you are basically betting or expecting the price of that stock to go up. So you would buy a call to negotiate buying those shares at a lower price. Okay? It is, but it's not like a lot to take in, but it'll make sense, I promise. There are two types of options in general: American versus European. American options can be actioned anytime between when you purchase the option to when the option expires. But European options, which are a lot less common, I don't necessarily know if it's like a literal geographic thing of like, American versus European stocks. Like, I don't know if it's less common here, but like it's the standard in Europe, I don't know. But European style options can only be actioned at the date of expiration. So, what is the expiration date? The expiration date refers to the period of time that the option contract exists for. Say tomorrow I buy an option and it expires in February. That contract is active from tomorrow through whatever date in February. Options that have longer expiration dates, aka longer time frames, they tend to be more valuable because you have more time to let the stock price move up and down, and there's more of a chance of you being in the money the longer the contract is. What does in the money mean? We'll get there. Now, like I said, the price that you negotiate to buy or sell at is also called the strike price. The strike price is the number that you expect the actual stock price to be above or below, depending on whether you're buying or selling, come the date of expiration. Okay? So, looking at the strike price is what will tell you if you should actually take advantage of the option or just, quote unquote, take the L on the fact that you bought the option. Here's an example. If you're looking at IBM stock shares, right? And if you think the price per share for IBM will go up to $250 in January, tomorrow you might buy a call option for $150. So come January, you can, as opposed to buying all the shares at $250 per share, you can buy them at $150 per share. Buy low, sell high. That's the whole point. If you haven't seen my video on investment basics, go watch that. Buy low, sell high. That's the entire goal. Now, also when it comes to options, you might hear the word premium thrown around. Premium is the price that you pay to buy the option. If you want to know the calculation, to know the premium price, you would just do the price of the call or the put, the price of the option times the number of contracts bought times 100. Now, in the context of a premium, each contract is equates to 100 shares of stock. So you might buy one call option contract, but that contract applies to 100 shares. So going back to the original IBM example, where you expect it to be $250 in January, but you negotiate to buy the shares for $150. Say you only buy one call option for $150. Come January, you can buy the 100. You can buy the 100 shares each for $150. Okay, that's how that works. Come expiration date, but the price that you pay, the premium that you pay to buy that option, to buy the option to action that price later, is calculated differently. So that's where the calculation is: the price of the call option, price of the option, times the number of contracts you bought times 100. So if you buy 5 IBM calls, then each call is negotiated for later. You buy 5 IBM call contracts at $1 per contract. So you would pay $500 for the 5 contracts. Come expiration date of each of the contracts, that's where the $150 for the 500 shares comes in. That's for later. It's like premium represents the price that you're paying right now. The details of the contract relate to what you're going to pay or sell at later. Okay? That's the whole point of an option. You are buying the option right now to pay a certain price later. I know it sounds like all this money is coming out, but like, you got to spend money to make money. That's like, this is how finance works. I know that sounded a little confusing, but like, I don't know how to explain it. Because I'm not going to lie to you, when I was learning it in class, people were like, calls, puts, like what? It's a lot. I'm not going to lie to you. You might just have to watch the video again. And not even saying that on some like, get my views up type thing. It's really just, you know how sometimes you just got to hear things over and over for it to actually make sense. Now, in reference to in the money, like I said earlier, right? There are 3 states, if you will, that you could potentially be in. Circumstances, let's say circumstances. There are 3 potential circumstances that you could be in as the actual stock price moves. You can be in the money, at the money, or out of the money. Okay? Now, blank of the money relates to your option price in relation to the actual market value of the stock. Okay? So if you're in the money, that means that your strike price, the strike price that you negotiated, is currently above what the actual price of the stock is in the market. If you're out of the money, the strike price that you negotiated is greater than the actual stock price and basically has no intrinsic value, so you wouldn't want to action that option come expiration date. At the money basically just means you break even. It flips depending on whether you have calls and puts and blah blah blah. Like it's really a lot. So here are some, for my visual learners, here are some graphs for in, at, or out of the money. In reference to a call, right? If I buy a call option, that means I expect that the stock will go up. So I buy a call option for a cheaper price. I expect IBM is going to be $250 in January, So I'm going to buy a call option to purchase those shares at $100. I'm restarting for this graph, right? I buy a call option for $100. Oh, well, I guess I should use the numbers in the graph, right? Okay, so let me use the graph numbers. I expect, what am I looking at? Give me a random stock. Black Smoke. Let's say Black Smoke goes public, right? Basically, Black Smoke is a tobacco-free, it's a black-owned, tobacco-free, nicotine-free hookah company. Shout out to the black folk. Black Smoke goes public. I expect that their numbers are going to soar because, hello, nicotine-free industry. Everybody loves hookah, right? I expect stock prices to soar, right? So, but I won't have the money to actually buy the shares until February, say. But tomorrow, I'm going to buy call options at $40 because I expect the share price to go up to 100. Right? So, the strike price is $40. That's not changing. That's the price that I negotiated. That's the blue line. The red line is the actual price of Black Smoke stock. So, assume the x-axis is, the different months. November, December, January, February, right? Present day, say we're at the beginning, right? Present day in November, the stock price is actually $22. That is no good to me because I want $40 to be less than what it actually costs. That way I earn a profit. So if the stock is currently at $22, $25, then I spent more money. Then I would be spending more money, right? So that means I'm out of the money. Let's say Black Smoke shares go up to $40 right before New Year's, right? Then I would break even and I would be at the money. Okay? It's not, you didn't lose money, so whatever. Cool. If you want to action it, you action it. If you don't, you don't. Whatever. Time goes on. Now come February, the actual price of shares for Black Smoke is $55. Now, that's a good thing for me because I negotiated to pay $40 for it. So now we're at expiration date in February. The actual stock price is $55. I'm going to pay $40 per share. So I'm in the money. Extra money. In the money. I got a profit. Love it. Does that make sense? Hopefully. Here's another one in terms of actual numbers. But same concept. If I expect, we can still use Black Smoke. We can do selling this time. If I already own Black Smoke shares, right? But I pay attention to how the market is moving, and I think come February, the price is going to go down, right? That's not what I want. I'll buy low, sell high. I want the price to go up. So I'm going to buy a put option for $50. Tomorrow, or for the rest of November, it's at $75. Time goes on. Where early December, price goes down to $65. Mid-December, price goes down to $60. Right before New Year's, price goes down to $55. With all of those numbers, I am still technically in the money because it is still the actual price of the stock is more than what I expect it to be. Profit. Okay? Come New Year's, I'm at the money. Stock price goes down to $50. Okay. And say but I don't action it come New Year's, I still give it time to see how it moves, right? Mid-January, price goes down to $45. Late January, price goes down to $40. Early February, goes down to $35, then goes even lower to $30. Now we're at expiration date, say it's end of February. Now we're at expiration date. I'm out of the money because I negotiated to pay $50 per share, but the current price is $30 per share. So I would not exercise that option because in retrospect, I will have paid to lose money, which is the direct opposite point of finance. So hopefully that kind of sort of made sense. Options are tricky business, and you really have to know what's happening if you want to get into that realm. But that doesn't mean you can't do it. I recommend you try it once you feel like you're comfortable enough with your stocks and you know how they move and blah 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 blah. But yeah, if that didn't make sense, please either leave your comments in the leave your comments in the question. Leave your questions in the comments, and I will try to clarify as much as possible, or really just watch the video over again. I tried not to be all over the place. I tried to like kind of sort of go in order, but the examples are really the only way to make it make sense monetarily, but also the examples make it confusing if you don't all the way understand what each thing means. So, yeah. If you made it to the end of the video and you don't know me, hi. My name's Naori. Stick around, you love it here. Duh. Embrace being a star. Subscribe. I don't know why I be holding on to lighters. Like, I really don't know. I don't know. Crackhead? That's what it's giving, right? Anyway, follow my socials. Bing. Hopefully that made sense. And if it didn't make sense, I really promise you can just put it in the comments and I will try my hardest to make it make sense. But I tried to keep this video as basic as possible, so I really think just rewatching it would make it make sense. Pause it, slow it down, whatever you gotta do. But this is really kind of as basic as it's gonna get. So, I think not. If you haven't been around and haven't seen that I've been doing No Excuses November, I've been doing real good, okay? I've been pushing out content. But November's almost over, so we're going back to regular posting come December. But yeah, that's really it. I will see you in my next video. Bye. I'd rather be smoking